All right, guys, welcome back to another week of the Educated Homebuyer Live with Josh and myself. This is where we answer your mortgage and real estate questions to help you become the educated homebuyer. So we've had a lot of changes over the last week. The primary one being today, the Fed and the Fed funds rate being cut by 50 basis points, which was the high end of expectations. Before we go any further on that, though, I want to ask a favor. Can you guys actually hear me? Let me know in the chat. New microphone. We're having issues coming on to the show tonight, so I just want to make sure that you guys can hear me, that the audio quality is good. So if you'll let me know where you're watching from. So if you can hear that, let me know where you're actually watching from tonight. City, state, all of that. You cannot hear me. That creates a problem. Loud and clear. Okay, so I got loud and clear and no, can't hear you. So Freddie, turn
Where
on.
did you find
Is Josh clear? Because Josh is not coming across clear to me. Okay,
my
very good.
the $24 million question though, Jeb? Where did you find this mute?
This mute, it's that, see that bar that's coming across the top there?
Yes. How do you turn it off?
You just tap it.
You just tap it. See?
Yeah.
We are tricknologists around here.
There you go. That whatever you just did changed.
Okay.
So your audio quality is better on my side. Anyhow, we good? We good? 66 people watching.
We do not know. We do not know whether we're good or not.
Well, Josh, yours isn't coming clear to me. It says Josh is not clear. So that's what I hear too. I hear you are not clear, Josh.
Well, and I'll pull in the mic.
Okay. Yeah, you're going to have to do something because that's not working. So while Josh is doing that, we're actually going to take a look at charts this evening, as we always do. And we like to start with inventory because inventory tells the tale. It's the tail that wags the dog, if you will. So with that, we have 713,660 active unsold single family homes on the market right now. That's up 10,014 week over week and sitting about 38% year over year. We did see about a 1% increase, which we actually discussed last week. Per Mike Simonson, he said we're going to see about a 1% increase, which is normal for mid-September. We actually saw that increase this week, coming in a little bit higher than 1%, but we did see that increase, and we're now sitting at 713,660. Orange County, we saw listings tick up 0.52%, so just less than 1%. And we're sitting at 3,648 properties. And Huntington Beach, we actually saw a decline, down 3.29% week over week, sitting at 243 homes. If you're joining in now and you're wondering where the hell Josh went, Josh is trying to get a new mic on because I bought us new mics and we didn't have time to test them because I've been in a home inspection and literally just came in the office right now. Single family new listings this past week, 65,000 new unsold listings. Don't have the number of immediate sales because Mike Simonson did not put out the charts this week. So we're just going to flow with the housing wire charts. You see Josh underneath his desk. It's a good place for him. Week over week change. We went from 703 to 713. Our yearly peak now is 713, which is where we sit this week. And our all-time bottom is that 240 number that we saw back in 2022. We currently have more listings on the market now. This is the highest level of listings, I think, since about September of 2022, if I remember correctly. Total home sales pending. We always like to look at that. We're up 3.5% more than last year. And that's going to take us into, actually, I didn't put in the chart. So price cuts are sitting just over 40%, so 40.1%. Now, the reason I put this chart in here from Resi Club is we're always talking about people, how many people own their home free and clear. Right now, we've at the highest level that's ever been recorded, and this is back in 2023. So the data is still a little bit old, but we're almost 40%, Josh, of homeowners out there sitting free and clear.
How about me? Can you hear me free and clear?
Dude, the quality is so good right now with the old
All right.
mic. With the old mic.
Wonderful.
I love it.
Old school.
Old school mic. So
well, I like, Jeb, that I sounded underwater and like a robot. So I should go back to that. Maybe an underwater robot. People will like that more than Josh.
I mean, I'm going to ask, how's the quality of the new mic? Is it good? Is it better than the old mic? Does it sound better than
Does
Josh's
Jeb sound
mic?
better than me? I'm on the old mic. Jeb's on the new one. So does Jeb sound better?
Yeah, we need to know. I mean, these mics were quite a bit more expensive, so I need to know if they're justified or not. A lot of people out there are asking about compensation, how it's changing. This is a chart, again, from Resi Club, just showing this is new construction, but it's showing about 85% of builders out there haven't made any changes to buyer's agent compensation at the moment. So they're still doing what they were doing prior to the changes. 10% have actually lowered buyer agent compensation. 6% switched from a percentage to a flat fee, and 0% raised the buyer's agent compensation. So nobody's raising it at the moment. The majority looks to be keeping it the same, which is kind of what we're seeing out there in the market for the most part. A lot of times we have people talking about BlackRock, Blackstone, Black whoever owning the I think it's Blackstone. Oh no, it's Blackstone owning the majority of homes out there in the market. And as you can see from this, Blackstone owns less. What's actually written right there on the screen? Blackstone owns less than a half of a percent, a tenth of a percent, 0.6% of 0.06%, sorry, of single family homes out there. And
I
other
enjoy watching
institutional
Jeb do math live.
Dude,
Let's throw more math in the comments. Throw up math problems for Jeb to solve. I like
I
this.
could actually probably do those better than I can read this chart. And then other institution owned 0.5%. So combined, just around less than 1% of the real estate owned out there is owned by institutions. You got 105 million units of housing stock, and they own less than 1%. So they are not your competition, at least in most markets out there. Some markets a little bit heavier concentrated than others. So the key news today, what you guys want to talk about, is what happened with the Fed. They came out 50 basis points, Josh, stronger than expected, I think, for the most part. It was kind of a 50-50 going in, but I think the most people out there had 25 points baked into the cake, were unsure about 50.
Here's the fun part with it, Jeb. In retrospect, you can always, here's a reason how we should have known. Nick Timmeros at the Wall Street Journal,
Yep.
They don't call him the Fed whisperer. There is always a Fed whisperer. The Fed doesn't like to surprise markets, so they always sort of have a plant in the media that they will put out some ideas of what they're thinking. So late last week, were we at 50-50 last week on the odds?
No,
25 versus 50?
Less. It was
Like 60-40, 25, right?
Yeah, it was pretty low.
Okay, well, by Friday, the odds were in favor of a 50 basis point cut, and the only thing that changed is that leak to Timmerhouse, and so we got it. We got it today, and you and I have been talking. I don't know if we were talking about this on the show last week, but it didn't matter. The size of the cut did not matter. What was going to matter today was the dot plots, which also shouldn't matter because they're always horrifically wrong, and that's not taking shots at the Fed. It's the foolishness of trying to project things 2 and 3 years out into the future. So we're going to see that. We've got the chart to look at, but the dot plots and the wording, the way the Fed was going to make that announcement, what they were going to say, was going to be far more important than the actual 50 basis points. So we got 50. Let's take a look. A couple of other things. So we had something probably only of marginal interest here. One Fed governor dissented for the first time since 2005. They wanted 25 instead of 50. It's been unanimous. Every cut decision going back to 2005 has been unanimous. That was not the case today. The dot plot that they released says 2 more 25 basis point cuts, 50 basis point cuts between now and the end of the year. We're going to see that the futures market does not agree with that. They're going to be more aggressive than that. They see 100 basis points in total for the year. So we got 50 today, 2 more 25s. The 25 prediction is another 100 basis points and then 50 more in 2026, leaving us at 2.9 is what we're seeing. So this is the dot plot, Jeb. I don't know if you saw this. Red is where we were the last time they put these numbers out. Blue is today. You can see that's not a little move lower. That is a big move lower, both for 2024, for 2025, and then 2026 isn't all that changed, and then their longer run is pretty similar, which reflects just, again, the difficulty or impossibility of projecting long term. We're kind of comfortable thinking what we might think would happen for next year. Beyond that, it's a wild card.
Definitely is a wild card.
Jeb, do you have something going on your side with audio?
I do not.
That's awesome. My headset was picking up something else here in my office. That was me. Okay, so what did Powell actually say? He had the question, why a 50 basis point cut today? He said, you can take this as a sign of our commitment to not get behind. They were still pretty darn restrictive. So at 50 basis points, it is still restrictive. That gives them leeway and room to move forward. The labor market is in a solid position. We intend to keep it there. The U.S. economy is strong, and we want to keep it there. I don't know that either of those are necessarily correct in terms of being strong. I don't know what your thoughts are, Jeb. They're not weak. Let's say that they're not exhibiting weakness just yet. And then for all of us here, the educated home buyer, the question was housing prices might reignite and become more expensive with rate cuts. Housing inflation is the one part that is dragging a bit. We still do not have enough housing. Housing supply is not something the Fed can fix. Seems obvious. But we've had questions, Jeb, for the better part of the last 2 years. What's the Fed going to do with this? Well, the Fed can't cut rates. It'll do this. They don't have as part of their mandate housing affordability. They can't control it. So it's really just not part of their calculus of what they're looking at. So did you look at this, Jeb? I know you've been out, but have you looked at this post-Fed meeting? I'm not hearing you at all. Did you mute yourself
The
again?
mic on this thing is the most sensitive thing in the world.
These people are going to
Holy
leave.
cow.
They're going to be, these dummies
Holy
don't know how
cow.
to use technology.
I
We're
mean,
out
the
of here.
mic, it's got a mute button right here on the thing. So if you touch it at all, it automatically mutes, which I guess is good because I don't really have a lot of valuable stuff to say, but it is it kind of put in a weird spot. Anyhow, no, I have not looked at it. I was at a home inspection. I literally got in here. It was able to turn on my screen. That's why we were a little bit delayed in coming on because of me. So no, I haven't had the opportunity.
This is what is a little bit insane. So a 70% chance of another 25 basis points at the next meeting, 30% chance of 50. And unless something takes a downturn and we start seeing a weak economy, weak employment, we're not getting another 50 behind this 50. But look to the December meeting, Jeb. The odds are that between the next meeting and the final one there that we get another 75 basis points. That's a crazy projection. And there's even a 25% chance, 15% chance that we get more than that between now and the end of the year. I think that's overly aggressive. We've seen this a couple times, the futures market kind of get out ahead of itself. But maybe they're seeing something better that we don't see. In looking at this, you can see they're out through the end of 2025. That is another 125. So they're projecting 100 more between the end of the year and another 125 in the next year. That's pretty aggressive. I don't think that I would go that far out. 125 basis points of cuts next year after another 75 this year would be a super aggressive number, but anything is possible. This is my favorite chart of the day, Jeb, because what has been my favorite, and I use that with a heavy dose of sarcasm, question that we've got over the last week to 10 days. Any guess, Jeb, what that would be?
Oh, I know what that question is. How low are rates going to go once the Fed drops the interest rates, right? Not the Fed funds rate. Once they drop interest rates, how low are interest rates going to go is the question.
I don't want to lock. I don't want to do anything. I want to wait because I think the Fed's going to cut. Well, I said, well, we know the Fed's going to cut, but mortgage interest rates have already dropped 1% over the last 90 days or so. And as you can see, so this is the 10-year treasury. This is the 5-minute chart of today. So you see kind of improving throughout the morning. And the green box was the Fed announcement, 50 basis point cut. And you go, ooh, they drop. And for the better part of 1, 2, 3, 4, 5, 6 candles, so about a half hour, they stayed at that newer level, which was like 364, 365. And then what happened at 11:30? Powell starts talking, and the market didn't hate it. This isn't a big move. This isn't a big move at all. The market didn't hate it, but when they hear him saying, hey, we think we got this under control, strong economy, strong labor market, but inflation's moving back towards 2%, then we kind of hit the higher levels of the day. So that is the market telling you, we don't really know what's next. Give us some days to digest, give us some more data going forward. But Powell did a good job of giving them 50 basis points, but not giving a lot of fuel for wondering or thinking what's coming next. So just look at these two side to side. So this is one day in a 5-minute view, and you go, oh my God, that's a whole lot of volatility. If we look at it down here, That's that little second to last from the right green candle. So were we up today? Yeah, we were up 5 basis points. But if you look, it takes us back to about where we were a week ago. Still well within this down channel, still under all of these moving averages. We could run up and touch those moving averages, but we have a downtrend still intact. So Jeb, you had thrown this chart in here. I moved it for you. You were probably wondering, where in the hell did my chart
No,
go?
I threw it in because we talk about it often, but I think this chart gives a really good view of where we were 2019 in that spread, where we are now, because we talk about the normalizing of the spread. People are like, what the hell does that mean? And you can kind of get an idea, going back prior to the pandemic, we were at 170 something basis points, right? Now we're at 255 or 250. So, if you have some normalization in that spread itself without even the Fed doing anything, you have lower mortgage rates, right? And so, more or less, just I wanted to throw it in there just because it gives a better indication versus us just talking about it of what we're talking about.
So I threw this in here, Jeb. This is, when you're looking at the spread, that chart is the way it is most commonly quoted, which is the Freddie Mac Primary Mortgage Market Survey that comes out every Thursday. That's 4 days out of date when it's released, and it is horrifically flawed in the way that it's gathered. Fred also collects the Optimal Blue Mortgage Market Index data, which is updated every day. So I basically created this calculation here that shows the spread. Fred allows you to do some cool stuff. So it takes 10-year Treasury yield and it takes away the spreads. And so what we can see here is in just over a month and a half, we've gone from 261 to 238. So other things being equal, if the 10-year had not dropped at all over the last month, mortgage rates got 20 basis points better. So 238 is still really high. If we go back and look at that chart, I mean, we see periods of 138, 171. That 170 to 2 is normal. When we get below that, it happens. It happens more often than these blowouts where we get really high. But all we need is a little bit more movement in that direction, a little bit more movement lower in the 10-year. We had the chart last week, Jeb, point out to, again, everyone, in Fed cutting cycles going back to 1980, before the first cut, the 10-year usually drops 140 basis points. From the first cut to the bottom, it drops another 150 basis points. So again, if you get 150 basis points from here and you get 25, 30 points of normalization to the high end of normal, 210, something like that, rates are an awful lot lower than they are today. So again, love to show this chart here, not because I'm happy that rates are up week over week, but look, over the last week, over the last day, every loan program per Mortgage News Daily, and this is accurate, we don't put it up here for any other reason than it is probably the most accurate index that you can see online. And with this, everything's up. Massively down over a month, massively down over a year. But when we look at the day and the week, yes, the Fed cut. The Fed does not directly control mortgage rates. They control the overnight rate. They control the prime rate. They have a heavy impact on the short end of the yield curve. But once you get out to 5, 7, 10, 30-year treasuries, they have little to no impact.
And something, you go back to that chart, Josh, you always like to point out is these rates here are quoted rates on Mortgage News Daily. If you have great credit, you're an A+ borrower, chances are you're getting better scores in this. And in fact, I did a video this past week on my channel where I did a how much you can afford video with FHA, and I did updated rates at 5%. And people are going, how are you quoting 5%? I said, I'm getting quoted 6 1/8 or 6 and whatever. And I'm like, okay, well, maybe if you're not a well-qualified, borrower, you're getting quoted something like that. But if you've got good credit and you're doing FHA, you should be somewhere in the low 5s. 5% is not unreasonable. Talk to somebody else. So understand that these rates, you could be lower than these. You could be in the 5s right now on a 30-year fixed if you have good credit without paying a bunch of points to get it. So just know that. And with that said, if you are in the market out there, you've got a quote, you're already in contract, you want somebody to look at it. We did a lot of second quotes last week, Josh, or you did after the show. People reached out and said, hey, am I getting a good rate? And you were able to help some, you couldn't help because they were getting a great rate. So if Josh can be of assistance to you, the red states is where we serve. The blue states is where we'll refer you to our lending partner, David. But either way, you'll be in good hands. So if we can help you, Josh can help you with refinancing, purchasing, call us. We would love the opportunity to help. And those same states are states where I can refer you to an agent. We just closed out 2 others today. So 6 people I've helped in the last, I don't know, 40 days or so who have bought a property out of state and been fortunate enough to reach out to us and get help. So that referral link on the bottom of the video there will get you in touch with us, and we can get you in touch with a pro. Probably Josh. Josh will be that pro.
And what I will say, Jeb, those loan estimates that we've been getting and seeing over, just some really batshit crazy loan estimates. A borrower out in Vegas, $300,000 loan, $15,000 in fees. It did include the upfront mortgage insurance premium. So on a $300,000 loan, was it like $5,000, but $10,000 of fees on a $300,000 loan. They had $8,000 in box A, and they insisted that this was a 0-point loan. Borrower has been listening to the show for a while. He goes, how is it a 0-point loan when you have $8,000 in box A? And he goes through it and goes, yeah, there's no points. And you're looking at a $7,000 mortgage broker fee. You're like, what is a mortgage broker fee if not points? And it kind of goes back to the point, Jeb, call anything in box A, whatever you want, just add them up. Those are points. That's the points you're paying for the interest rate.
Good stuff. Let's see here. I'm trying to go through and find questions. AB asked me for a math question. 2 times 0. I know that one. It's 2. No, just kidding. It's 0. Let's see. What else we got here? Josh, do we have any? Were you flagging any questions as we're going
couple
through?
Of early ones. So yeah, if you
we'll go with Susie.
I'll keep rolling through. And
Susie gave a $10 super chat, so thank you for that. Susie said, "Called my bank today. There is no funding for down payment assistance or first-time homebuyer assistance. What programs are available for first-time homebuyers?" So, I think there's a lot of confusion out there in the market when it comes to first-time homebuyer programs, that these things are always available, and that there's the problem is that they vary by state, they vary by county, sometimes they vary by city. So it can go down kind of a rabbit's hole, if you will, in trying to find some of these programs that will actually work with you. The problem with states like California is that most of them, there's no funding for them. It's not in the budget. They pulled that money in the budget away to use for other things. And so the down payment assistance is gone. Now, a lot of people look at programs like FHA and USDA and some of these programs and call them first-time homebuyer programs because they allow a minimal down payment. Now, California has CalHFA. Other states, you often talk about Texas, Josh. Texas has a bunch of down payment assistance programs. So depending on where you are located in the country, there might be a lot of options. California, unfortunately, doesn't have a lot. And even the ones they do, they're not properly funded. And so there creates other issues. And I think, Susie, you're in California, if I remember correctly. But just, Josh, you were going to add something?
No, she is in Sacramento, and she followed up here. I've been through 3 lenders, and none has offered me any assistance programs. So I can just tell you, in California, there's no good assistance programs. Everyone thinks that assistance is magic. It's free money. CalHFA, GSFA Platinum, Shinoa, any of these assistance programs, they're really expensive loans. So people go, hey, I see rates are 6% or 6.15 or 6.11, whatever the number is. And they go in, give me that and give me some money to buy the house.
Give me that.
It isn't the way it works. They're going to go, okay, we're going to give you a 6.875 rate. And then we're going to give you a second mortgage that is, you don't have to make payments on it, though. And then we're going to give you another third mortgage. You're going to owe 103% of what your house is worth.
Ooh,
you're not going to have to make payments on those. It's going to limit your ability to refinance going forward. And you have a higher interest rate than you needed otherwise. I will go back to saying we have great 3% down programs that are available in every state in the nation. FHA, 3.5% down, available every state in the nation. If you can't get to that point, we need to figure out what we're doing and if buying a home is appropriate. There is a financial foundation you have to put under yourself before buying a home, because there essentially is no free money out there. I will say that we've talked about a couple of the programs, seen one in Tennessee. I'm like, that's pretty awesome.
Just because you can qualify to buy a home doesn't mean you should buy a home. Right.
Yeah.
You got to have the foundation. You got to have that stuff. And maybe you have it. But down payment assistance shouldn't be the end all be all, right? For most people out there. Our Carlos has a comment, or rather a question, but I'm going to take it as a comment because it's something we've heard a lot over the last week. And it's basically like, why would I do something today when I'm going to be able to do better, get a better rate after the Fed cuts? And the reality is you're probably going to pay more for that mortgage tomorrow rate wise than you would have yesterday. And the reason is because the volatility in the market. We talked about it leading up to this. We talked about how the Fed has been transparent in what they're going to do. They've laid it out and they don't control mortgage rates. So, in order to see a move at this point, you've not only got to make up what you lost today, which isn't a huge move, but then it has to move down even further. And you're kind of at this resistance area in the market where we've hit it more than a handful of times on the 10-year, and we're not likely to just push through it, right? We need more from the Fed. Now, could that come from jobless claims on Thursday? Could it come from some other data? Sure. But it's not 100% certain. That's why if you have an opportunity to refinance, take advantage of it when you can. And then if you get another opportunity, fantastic. But the key is don't pay a bunch of points to do it. Don't pay a bunch of closing costs to do it. Try to do it at no cost so that when another opportunity arises, you're good to go.
Yeah. In a perfect world, if you can get your break-even period to 6 months or less, we've talked about that 180-day EPO. You don't want to stick your lender with that regardless. So plan on having it for at least 6 months. If you can recoup the costs there, if the opportunity exists at the end of the 6 months to do it again and drop the payment more, cool. You didn't really pay anything for that first loan. You gave yourself an option. You locked in that lower payment with an option to roll it lower again in the future.
And AB has a really good question with regards to what the Fed controls rather with the Fed funds rate. And he basically asked the question, does the 0.5% Fed fund drop mean that HELOC rates will now go down, home equity lines? So Josh, is that one of the things that are adjusted with the Fed funds rate?
I have seen a couple of off-the-wall HELOCs that are not tied to prime, but 98.9% of them out there are tied to prime. Prime moves directly with the Fed moves. So absolutely yes. And a lot of people who had those ultra low 2020, 21 interest rates through 22 and 23 have HELOCs. And we were telling them, please do a fixed second and don't do a line of credit. I don't know when I'm going to use the money. I'm going to take out the line of credit. It's only 4%. A lot of those up 9.5%, 10%. So they will come down. And if the projections are correct and we see another 200 basis points of cuts, those will come down 2%. So right now, a HELOC can be a great option to finance something because you're going to ride that interest rate down. Whereas it was the opposite when rates were really low. People should have been taking fixed seconds.
That car loans should get better. If you're out there trying to finance a car, that should improve. You might see it in credit card statements. Your monthly payment might go down a little bit. Just if your balance isn't continuing to go up every month, with the Fed funds rate going down because it controls those short-term rates like that. Josh, David has a question around FHA Streamline. So I'm going to explain what a Streamline is. You can explain what the fees are. So an FHA Streamline, if you have an FHA loan already, it's essentially a streamlined process to refinance. So if you have FHA, you go FHA to FHA. And one of the cool things is no appraisal required, no income documents required. Josh, don't really have to prove
no income qualifying, no appraisal documentation. And really the secondary markets beg to differ, but HUD says there's no credit score requirement. As long as you can show that you've been making the payments on time, that's what they want. Most lenders do have a credit score requirement on them.
All right, good stuff. And Josh, he asked about closing costs.
Yeah. And in terms of the fees, the biggest problem with FHA loans, so most of the people reaching out right now, let's realize they didn't buy in 2021 and have an amazing interest rate. Those people are sitting on great rates. So the people that bought in the last 1 to 2 years. With an FHA loan, you pay an upfront mortgage insurance premium. It's 1.75% of the loan amount added on top of your loan, except for if you're the 1 in a million that actually pays it in cash. In the first 36 months, you get a prorated refund. After a year, it's like 50%. After 2 years, it's like 20%. So there's a maximum mortgage calculation on an FHA because they're saying, hey, we don't need an appraisal. We don't need income documentation, but we do, or this is the maximum we're going to loan you. And it's essentially your current loan balance less that refund, plus 30 days of interest, plus the new mortgage insurance premium. That's the maximum loan you can get. So some of those crazy loan estimates I've been seeing, Jeb, is hillbilly loan officer sending over, adding like $20,000 onto someone's loan amount. And I'm like, even if you agreed to this person doing it, they can't do it. So
are you talking about my people?
I'm talking about some of your people.
Yeah.
The Kinston mortgage mafia.
Hey.
But so you're going to have that 175. There's no way around it, and you're going to get a little bit of a refund of that from the purchase. But that of all of the loans are going to be more expensive than any of the conventional loans. Don't have that problem, but you have to do everything on that loan. A VA loan, they don't give you a refund of your funding fee, but they have a reduced funding fee on the refinances of 0.5% instead of another 1.75. So other than that, you're going to have all of the normal closing costs except an appraisal. You're not going to have to pay for an appraisal, but you're going to have title fees, escrow fees, recording fees, a credit report. So it will definitely be less. And it depends a lot on what part of the country you're in. I've been talking to people all over and from state to state. We had this question last week and I said, hey, plus or minus $3,000, which is still about right for most of the loan sizes we're talking to for people here. But I've seen 4,000, I've seen 4,500, and largely the difference is some of these states have mortgage and intangible taxes, which it's mind-boggling that they tax their citizens for improving their finances. And then the other one is title fees, just vary state to state. So I had a client in South Carolina we were talking to today. It was $2,700 for title insurance. That same policy in California is $600.
Yeah, crazy. So it does vary by state. So just, that some of the stuff you can't control, but just talk to a couple people, compare it, and ultimately, those fees aren't going to vary regardless of who you go to. Love for Puppies says, can you add someone to title if you have a mortgage on the home without refinancing? And the easy answer is yes. You just record a new grant deed, and you add somebody to title. It's pretty easy to do. You just need the right document. You got to have it notarized, and then you file it with the county. At least that's how it works here in California. It might work different in other states.
Now, Jeb, let's point out the one complicating factor. If you're not doing it through a transaction, a purchase transaction, a refinance transaction where you have that title insurance, it's an uninsured deed. Most times when you do go to finance or sell that property going forward, to get title insurance, they're going to make you track that person down and get that deed re-signed most of the time.
There you go. Forgot to mention that. Jackie says eggs cost $12 to $14. How does that mean? How does that man think the economy is good? ? So do eggs really cost $14? I don't do the grocery shopping, and
nor do I.
I thought they were like $7 or $8 now. Are they really $14?
Jackie might be in California though, because we had some friends that were former Californians that went to Texas and they came back to visit, and they went just to get milk, eggs, basic stuff. They're like, oh, everything's like 40% more here for basic.
No, there's no way eggs are $14. Somebody tell me in the chat, because like we go through like, I don't know, 2 18-packs of eggs a week. There's no way I'm spending $30. You're going to tell your kids
they can't eat eggs anymore?
Yeah, I'm exactly what I'm going to tell them. So somebody help me out with that. But here, does that mean the economy's good with prices, right? No, there's definitely higher prices, but here's the thing is the Fed isn't looking at the cost of items. They're looking at the increases of those costs as a measure of inflation, right? So the fact that they're $12, how long have they been $12? Have they been $12 for a week or a day or a month, or is that the way they've been for the last 6 months? If you don't continually see those increases, right? Inflation at the moment's what, 2.7% or so, Josh, 2.6, somewhere in that ballpark headline. That's an annual increase in prices. So yeah, prices are going to increase at a certain rate, but they shouldn't be 30, 40, 50% increases year over year just because of where inflation is, unless it's a supply issue.
It for you.
Let's hear it.
A Lucerne 18 count farm eggs, cage free, large, $5.99. But
yeah, I go extra large.
As Freddie pointed out, pasture raised, the Vital Farms pasture raised 18 count. Now it's $10.99. So that's not a dozen. That's a dozen and a half. If we go down to 12, it's $7.99. Eggsland's Best. I don't know if those are
all right. Raised. You're getting ripped off. So here's the deal.
Shop at a better location.
If you need to buy eggs, contact me. I will sell them to you for $10. Josh, see what we're doing here. We're buying them for $5. We're buying them for $6, selling them for $10, making $4. It's fantastic. They're getting them $4 better. Everybody wins. No, in all reality, yeah, the cost is up. I get that. We had another super chat coming in, and this one is from Umer. Thank you. The super chat says, purchasing a new home. Builder gave me an option of a 1-2 mortgage. Mortgage 2, a first and a second mortgage. Mortgage 2 is a HELOC for $230,000. Is this better than a jumbo loan? Should I use additional funds to buy down points or lower the HELOC amount? So, Josh, what are your thoughts on that?
So we go back to this conundrum of its builder. The builder's probably giving an incentive to use their lender. They probably don't have super competitive jumbo options. So this is how they make it competitive. And you may say, well, what if the jumbo's better? It's going to have to be an awful lot better if this is what we're typically seeing in terms of $15,000, $20,000, $30,000 credit towards closing costs, which we've talked about is probably really 60% of that is the real credit. But they make it very, very hard to use another lender. Going back to what we just talked about, if prime drops 200 basis points over the next 2 years, you're going to like it. Payment's going to go down month after month after month. We're probably going to see home prices continue to go up. One of the things, Jeb, we didn't talk about, we have lenders doing their typical this time of year, jumping the gun on 2025 conforming loan limits. So we can go up to
802, I think.
803. Well, they one up each other. A couple of them came out at 802, 650. Someone said, we're doing 803. So if we see that, the actual number, Bill McBride has kind of reverse engineered it. They think it's going to be somewhere in the 850 range. So if we see 850 and then next year is 900, maybe your loan's no longer a jumbo and you can refinance out of it. So I guess I would say shop around, see if someone has better jumbo terms. But if you have a large credit that's dependent on using the builder, it's probably going to be the best way to go.
Good stuff. Josh, do me a favor. Look at what programs you have open. Shut them down. If you got a bunch of stuff, pull them because your audio went out on me there, and I'm assuming everybody else heard the same thing. Siete, number 7, says, are new construction loans able to reach 4%? I'm seeing 5.5 with D.R. Horton here in Central Valley with conventional loans. So, Josh, if 5.5% with a builder is definitely a buy down presently. Asking about
well, Jeb, let's say this. I think this is an important point to make. These were refinances, and these were people with more than 25% equity in their property and very high credit score, 780 to 850, locked 2 refis this week at 5.625, and those people didn't pay points to buy that rate down. So tells me a couple things here. It's getting much closer because the builders only give these incentives. They're not doing it out of the goodness of their heart. They're doing it because they want to move properties and they know what's required. So are builders able to reach 4% with where they are today? They could absolutely buy it down to 4% if they wanted to. They don't want to do anything. They don't want to give you a dime. If they had people camped out, lined up to buy those houses, they're not giving you anything. If you remember, Jeb, during COVID, we had places that were saying, submit your highest and best on new construction. So we went from that to buyers going from complex to complex going, hey, what's your highest and best incentive to get me to buy one of these houses? Builders, and if you go on their quarterly earnings calls, they've been saying varies region to region, complex to complex. If they're moving these properties, they're not giving incentives. And I would expect that home sales will pick up as rates continue to trend down, and you're going to see a narrower and narrower spread as the builders don't have to do that to move properties.
All right, good stuff. So I saw a comment a moment ago, Josh, here, and I want to put it up on the screen because I think it's where did it go? Where did it go? Basically says, Melissa says, I think the cost of goods will continue to increase due to minimum wage increasing. My 2 cents. So, Josh, I'm listening to a book that you recommended to me called Same as Ever by Morgan Housel. And one of the things he brings up in that book is something called the financial instability hypothesis, which essentially means when an economy is stable, people get optimistic. When people get optimistic, they go into debt. When they go into debt, the economy becomes unstable. And he basically says stability is destabilizing. So what happens during the pandemic, what happens is when people start to make more money, guess what? They spend more money. Debt increases. The government's doing it, for God's sakes. We're like $37 trillion in debt, and it's not going away anytime soon because both presidential candidates are going to spend money that we don't have. So you're going to see more instability in the market as we continue to go further. and that statement doesn't translate directly into that. But what I'm saying is, like, we've got instability coming in the market. And, if you want to know how interest rates can go lower than they are right now, it's with that sort of thing happening. So anyway, just side note, went off on a tangent. Josh, let's see here. We've got,
let's go to this one. It's a
Okay.
simple one. Aaron says, is it better to look for an ARM than a 30-year fixed rate to sail until the market drops for 30 years? I'm sitting at 7.1 currently. You're not going to see much of an incentive to go to an ARM. If you believe firmly that rates are going to continue to go lower and you're going to refinance out of it, with a 5-year, you might get 0.25% lower than a 30-year. So most people look at that and they go, I am not willing to trade that stability for that little bit of savings. The logic follows that if rates are moving down, you're less afraid of an adjustable rate, but no one's really doing truly adjustable rates. We do have that one, Jeb. Next Bank offers that program, that it is a 1-month ARM. It adjusts, and it's tied to LIBOR, and LIBOR is highly correlated to Fed funds. So I guess, Aaron, you made my brain think about something I wasn't thinking about. If you're a gambler and you are comfortable and you believe that we're going to see that 150, 200 basis point move down, and you're buying today, do that, refinance out of it in a year or two.
I had a buddy who Josh, who owned a very expensive piece of real estate down in Laguna Beach. And when rates, I mean, this was back in, I don't know, early 2012, 13, 14, somewhere in that ballpark. He had like a 1-month LIBOR. It was like 1%. And every month the payment came and it just continued to go down. I mean, his house payment was cheaper than mine, and the piece of property was worth like 10 times mine. It was crazy.
There are some crazy things out there. So when rates got ultra low, I golfed with a buddy last Friday. He works for Bank of America, got an employee loan. He's on a 10-1 ARM at 1.55%. I've got another buddy who bought in Corona Del Mar at $2 million right before things went nuts. And then things went nuts and the interest rates came down. He's also owns a mortgage company. He had a connection. One of their investors did a 10-year ARM for him at 1.75% interest only. So his payment to live in like a $5 million house in Corona Del Mar is absurd. So there are a few people that milk that system.
And yet he's still gaining equity because the home price keeps going up.
Yep. So ARMs can be played and work well. I don't know if I've told you this, Jeb, but in 2003, when rates dropped, we refinanced to a 10-1 ARM at like 4.875. I'm like, that's amazing. It's under 5%. And I just figured we wouldn't be in the house for 10 years. Well, at the end, when that thing adjusted, I look at it and I'm like, this is going to get better. That we just refinanced out of that in COVID, because for years I was at like 2.25, 2.4. It would go up and down every year, but it was always under 3%. I'm like, why would I refinance out of this? It's great.
Too funny. So Melissa is basically asking, Josh, how do you shop around to get the best rate, or what's the best way to get the best rate? So I'm going to throw that out there.
What's the best way to get the best rate?
Well, I mean, how do you get the best rate? What's the way to do it? Do you shop around with various lenders? Do you talk to one? Do you talk to three? Like, what's the best method?
You could literally luck into it on the first lender, but you don't really have any point of reference. Watch this show. Look at Mortgage News Daily. Look at those rates they're quoting. Look at Optimal Blue Mortgage Market Index. When you go in, most banks, none of us go to the bank as much as we used to, but if you're in there, look at the rates that they're quoting and call a couple of people. The best way to get the best deals, like, this is what's insane to me. The people who are like adamant and insistent, like, I got to get this, the lowest rates and fees, they'll have like a 692 credit score. And they'll be like, well, you guys were talking on the show about locking rates at 5.625. I'm like, well, you have 5% equity in your home and a 692 credit score. Those terms are very different than having an 800 credit score and 25% equity. And that's not a shot at anyone that just bought in the last year. It's just, you got to realize those loan level price adjustments that we talk about all the time, they get lower as we go lower in loan to value. So the more equity you have in your home, and then they go lower, the higher your credit score goes, even though people put a big scare into everyone that people were going to pay more when they have good credit. Absolutely not the case. So if you want to get the best deal, I will say this: you will save more by going from a 700 credit score to an 800 credit score than you ever will by shopping around terms.
Yeah, and here's what I'll tell you in knowing the business. I mean, owning a mortgage company for over 10 years, doing what Josh is doing and overhearing the conversations that Josh has, those shopping for the best interest rate are typically the ones calling at the last minute because they're getting screwed some way because they're not getting what they promised, or the loan's falling apart, or they're not closing on time, or their loan's not approved at all because somebody didn't do their job correctly. So the easy answer, talk to professionals, but talk to a broker. Josh is a broker. Use that referral link on the bottom. Talk to Josh. Talk to your bank, right? I will tell you, brokers are typically better than banks. Sometimes if you have a credit unions offer good programs sometimes. Credit unions can be slow. They definitely have issues, but sometimes their rates are good. But you just have to know what you're dealing with, what you're working with, and then have a point of reference to compare it to. At the end of the day, the best rate isn't always the best deal or the easiest deal to get done. So go with somebody that's answering your questions, that communicates well, and can ultimately get you to the finish line, because that's the most important piece.
And Jeb, along those lines, I would say most people tell me the reason why they go is our rates and fees are competitive. Like we're not getting beat. Occasionally, 10, 20% of the time, someone will have talked to someone and they're similar. They're in the range. We might be $500 more. We might be $500 less. Most of the time, we're significantly cheaper. But what I will say is what everyone tells us is, I've talked to 3 people. None of these idiots could explain what's going on. So it is important that you know what you're doing. You know what the different boxes mean. You know what your choices and options
Know
are.
how to compare. Yeah.
It makes my conversation with the borrower probably 2 to 3 times longer. But by the time we're done, we've gone through everything. Are we going to have impounds? Do we want to go to a 29 year because you bought a year ago? All those things. We're going to quantify that so that you feel confident. So you want to feel confident you're getting a really good deal, but you also want to be confident that it's the right loan. The greatest deal on the wrong loan is not going to be the best thing for you.
No. I told the story about the guy that called me. He had a loan of 246, and the lender wanted to take him up to 260,000, but he was saving him money on the long-term interest because he was putting him into a 20-year fixed. I'm like, bro, that's not a deal. Like, I think you're getting screwed here. Anyway, let's move on. Let's see. I haven't read this, but Jersey Boy says we closed on a house 3 weeks ago with builder financing at 6.625%. Should we refinance now or wait? Should we? I'm sorry, I'm trying to translate all this. Basically, do a 5-1 ARM or a 30-year fixed. If rates drop later, we can refinance in 2026. Any suggestions? So I guess the easy answer, Josh, somebody that's just bought when rates were higher, they locked 30 days ago and rates were in the mid 6s on some of these loans, and now they're below 6. Should they refinance now? Should they wait? We talk about this all the time, and I hate to beat a dead horse. Same thing, but it's a popular question.
It's really case by case, and it goes back to, we talked a little bit earlier here about, where are you located? What does it look like? This username here is Jersey Boy. He could have relocated to California. We say many bad things about California. California, we're really lucky. Settlement costs low, taxes are not super high. Income taxes are high. Taxes on real estate transactions, other than if you're selling multi-million-dollar homes in Los Angeles County, or is it Los Angeles City, Jeb? Either way, from that perspective, if your costs are low, and we can do it again with your cost to recoup. If it's a $3,000 cost and you're saving $500 a month, in 6 months, you're going to come out ahead. So in that situation, we can easily justify doing it today, despite the fact that we think whether it's 6 months, 12 months, 18, 24 months down the line, we're going to be able to, because it's locking in that benefit, because we're not certain that it's going to go lower. But if you're in one of these higher closing cost states, the lady in South Carolina, the viewer of the show in South Carolina I talked to today, we left it at let's reconvene in 60 days. If the market moves faster than that, I'll reach out. But it was like right there, borderline. She was trying to push herself into it. I felt like if I pushed her, we could have told her it was a good idea, but like, it's right there, borderline. I think you guys are going to be better off waiting 30, 60 days and seeing where it goes.
There you go. Julius has a question here, more of a statement, but I'm going to turn it into a question. Says, I have a balloon loan and I've been waiting for rates to go down to refinance. My rate is up in the 5% rate. I'm in LA and would love to chat at some point. So Julius, reach out anytime to talk to Josh. But if you have a 5% balloon rate, right? Unless the balloon is happening now, right? If it's happening 2 years, 3 years, 4 years from now, there's no need to do anything, right? Your rate is essentially fixed at that, whatever that 5% rate is. So chances of you refinancing now are probably low. You probably want to wait for rates to get down a little bit lower before you fix that rate. But it would be a good idea to fix it with a long-term fixed rate loan if that's your goal. If you plan on selling the house in a year or two, then it probably doesn't matter. But if you're planning on keeping it long term, then you want to get it into a fixed rate sooner than later. And then if rates go down lower, you can take advantage of it again, right? But fixing it at some point is a smart idea just because you don't know where things are going to go. But again, based on what you're saying here, I don't think there's a rush to do it.
Well, Jeb, one point
Yep.
I think I'd like to point out there, Julie, is if it is truly a balloon loan, for those of you watching at home that don't know what a balloon is different than an arm. We just talked about, I had a 10-1 arm at the end of the 10 years. It just goes to an adjustable. A balloon, 5, 7, 10 years. Hey, you get to enjoy the house with this great interest rate. You got to pay me back. So I would say be more cautious with a balloon than with an arm, that, you know, your worst case is the payment goes up higher than you want it to. But Jeb's 100% correct. You have a longer window. You don't have to feel like you have a gun to your head.
All right. We talked about this earlier, Josh, but this is an example, so I'm going to throw it out there. CC Ryder says, how and when will HELOC rates change from this Fed rate cut? They have a 9.5% HELOC. So does assuming it's tied to the prime rate, which chances are that it is, does that mean next month their payment is going to reflect a 9% interest rate? Or how long does it take that adjustment to happen?
It will adjust before your next billing cycle. So most of them bill, it's every 30 days. So they'll tell you, if you go back and look at your home equity line of credit agreement, it generally tells you what day of the month, what index they're looking at, which we talked about is going to be prime, and what day of the month they look at it, and it will reflect the next billing cycle.
Good stuff. 260 of you on here at the moment, and not a lot of questions, guys. About 10 or so minutes left. So if you have questions, throw them in the chat. Let's get them knocked out here and get you guys educated. You guys, the educated home buyer, you guys are more like the educated home owners at this point, because there's a lot of people that own property looking for answers. But either way, it's why we're here, guys. It's to help you guys make the right decision because you have the right information.
Jeb, let's circle back just to educate these guys. So we've talked about this. I actually have an example. So Jersey Boy's situation here, if he really was in Jersey, I just plugged in Morris County, New Jersey, $500,000, title escrow, notary recording, $3,500. So if your lender's charging nothing, if you get an appraisal waiver, you're $3,500 into that. So the reality is you probably have another $1,000 to $2,000. And if you're with a high cost lender, it could be $3,000 into that. So if you have a $500,000 loan, the closing costs are $5,000 or $6,000. It changes this calculus. You have to know what those closing costs look like. And know what your recoup looks like to decide whether it makes sense. For a lot of people, it absolutely makes sense to take advantage of where we are today, despite the fact that rates are going lower. But for many people, it's keep your powder dry and wait for a better rate.
Good stuff. Conrad says, would you be willing to do tutorials on how to analyze small local markets? Would be interested in your perspective and consideration. So, you know, unless it's a market that I mean, this is me personally, unless I know the market well, I'm not really in a position, nor do I think my advice would be worthy of you listening to it without me actually knowing the market. So if it were Orange County, if it were Long Beach, you know, parts of LA, parts of San Diego, I could help you out. But if it's, you know, in another state, in another market, I just don't know that I would be the best fit. I would rather refer you to somebody there that I know, that I trust, that, you know, or maybe even referred to me by somebody else if it's that small of a market that can guide you through some of this stuff. There's too many things, you know, when it comes to residential real estate that affect values, that affect, you know, future values and different things that I wouldn't be comfortable doing it. There's enough data out there, and there's enough good people in, you know, most of these markets that could help you. Josh, would you be somebody that they could call
to analyze small local markets?
Yeah, I don't know. I'm just asking.
I'll tell you this, my first step, if I consider buying real estate in a market outside of mine, is to find someone local to that market. And I may not like that conversation. I may look for a second or a third person to talk to, but my first move is to find someone local in that market.
All right, good. We've got a question here from.
While you're getting that, let
Yep.
me answer this just real quick. Blackluster Soldier says, should I refinance now with 7%? At risk of
Yes.
sounding redundant, it depends. You know, I talked to a gentleman today, $350,000 FHA loan in Montana, 7.125% interest, and we're going to wait another month or two. So it depends on where you're at, the closing costs, the monthly savings, the recoup period. If you'd like us to help you work through those numbers, reach out at that link below.
All right, good stuff. Let's see what we got here. There was somebody, I saw it. I flagged it, Josh. They were asking me. Oh, Danny said, are you going to refinance every time you get 50 basis points lower? I would refinance every time it made sense. But here's the caveat is that I just filed my taxes for 2023. And I don't know that Jeb is going to be eligible to refinance based on last year's taxes. Last year was a drop in income for me compared to previous years. And so I don't know that I'm in a position to refinance. That's why I delayed in filing my taxes so that I could wait until rates came down. I figured they were probably going to come down before taxes were due. They did. I filed. I refinanced. Now I filed. And so we will see. We will see what happens and if I'm in a position. But I'll be honest. I told you I've refinanced 2 times already. If I can refinance, I am going to refinance. Why wouldn't I? It seems crazy not to. Every time I can save 50 basis points, I save $400 and something on my mortgage payment. It's down $800 from last November. Why would I not do that every single time I could? I mean, costs would be one thing.
And both of those, you got a lender credit with.
I got a lender credit, so there were no costs. At one time I skipped a mortgage payment. This time I didn't. So it all works out, guys. You just got to do what's right for you. What my scenario might not be right for you, and that's okay, right? Your scenario might not be right for me. That's okay too. But understand, I follow this stuff daily, sometimes hourly, depending on what the market's doing. You're probably not doing that. You probably have a full-time job where you're managing your own life and kids and everything else. I'm fortunate enough to have a lender, in the same office to me that I can bounce things off of, talk to friends that are in the business. But if you're not, talk to a lender, get on their list, get on their short list. Like if you're thinking of refinancing as rates go down, call Josh, talk to him, tell him what you're trying to do so that when rates go down, he can actually call you and say, hey, listen, this happened. Is this something you want to do or do you want to wait? And that way you're not having to follow it every day, right? That's why I tell people all the time, if you're looking to buy a house, chances are you're going to find the house. Jeb isn't going to find the house for you. Why? Because you as a homeowner are looking at these sites daily, like hourly, sometimes by the minute. I'm not looking at them like that. But on the flip side, I'm looking at rates. I'm looking at other things like that because it affects everything else I do. So just know that you got to position yourself so that when there's an opportunity, you're in the best position to take advantage of it.
Jeb, you're going to answer both of these questions.
All right, let's hear it.
How do you get a lender credit so you have no refi fees? How did that work, Jeb? Did they like you? They thought Jeb was a VIP client, so we're going to give him money?
So what happens, Josh, you can probably explain this in better terms, but what happens is every day there's a par rate, right? Which is essentially the best rate out there in the market for the most part. So let's say, for example, hypothetically today, the par rate is 6%. Well, sometimes with that rate, there's actually a little bit of yield spread that the bank is paying with that rate to the lender that they can use as a credit to offset cost. In the case that I was that day, I don't know if I could have gotten a slightly better rate. I got 6%, but I probably could have gotten 5.875 had I paid a little cost. I wasn't willing to do that. I wanted no cost out of pocket. So I took 6% and actually came with a credit from the lender that covered my cost. Right. So it was like $5,100 or something. Right. So my closing costs on that loan were like $3,500, $3,800. So it actually credited more than my cost that I had on that loan. But I did have things like prepaids that I had to pay though, because of the time of the year, I had to redo my impound account. Right. And I had to put 9 months of impounds in there. My property taxes are not cheap, guys. So I had to pay 9 months of impounds, but I'm getting a refund check from my company for those impounds. So at all said and done, I paid nothing for the loan, and I ended up with a better rate. So that's how you do it. So just,
remember this, Jeb is very well qualified with very good credit. The better credit you have, the bigger those yield spreads are. So here's the thing to remember: a bigger loan in a low closing cost state like California, no cost refis are fairly easy. If you have a smaller loan, $200,000, $300,000, and you're in one of these closing cost states where it's $5,000 or $6,000, it can be very, very difficult to do it at no cost. That's why some of this calculus comes back to how much am I saving? How quickly can I recoup it? Does it make sense to do it now? Or am I comfortable waiting for rates to go lower, which we all believe they're going to, but we don't know that for a fact. So for anyone who says, no, I have to have my payment $200 lower a month, okay, go ahead and trade some of your equity for that lower payment. But if it's a nice to have, but not a I have to have it to make my budget work, high closing cost state, low loan amount, you may wait.
Good stuff. Question here on an FHA loan, basically asking about a refinance. Should you do it now or should you wait? If you have a high rate, again, I can't speak on behalf of you, but me personally, take advantage of the opportunity when it presents itself, right? Because you don't know where rates are going. As much as I think rates are headed lower, it might be 6 months before they go lower. They might stay here for 6 months. And if you can save $200, $300 a month, I don't know what the number is, just making these numbers up every single month. Well, that means if it takes 6 months to get down there, you just saved, 6 times 3, you just saved $1,800 over that period of time that that you may have otherwise waited or pushed off because you were waiting on an opportunity. As we said, if you're going to refinance now, stop. Don't pay a bunch of points to do it. Don't pay don't pay points to buy down the rate unless you're, again, retiring or doing something where you're not going to be able to qualify in the future. But don't pay points and don't pay a bunch of closing costs to do it because you're likely going to have an opportunity in the future. Is it going to be 1/4% or half? I don't know, but I think there's an opportunity coming. And Josh, I would win in a wrestling match. Josh is taller and bigger than me, but I would choke his ass out. I'd roll. I don't even know jujitsu, but I would learn it.
Yeah. Well, the problem is I can't defend myself. I have a replaced shoulder. Jeb was
That's what I would go for.
The night that my shoulder destroyed. So he would like to have video of that and show that.
I do. I have a memory of that. I remember exactly when it happened, where it happened. I don't remember the music that was playing, but I have a really, photographic memory of all of that taking place. That was about 14 years ago,
friends that, it was like 13 or 14 years ago. Do you guys have any friends that laugh at the memory of you blowing out your shoulder that eventually required it to be replaced at an early young age?
Too funny. We got one. Well, let's answer this question, Josh. Can you buy land and roll the cost into a construction loan? I don't know the answer to that. Can you roll the cost of your land into a construction loan?
With a down payment. So it's all factored into it. If you own the land, the equity in the land can be your down payment and your equity in the property to meet loan to value requirements. You can do both at the same time, acquire the land and do the construction financing, but you're going to have to bring some money in to have your skin in the game. They're not going to do 100% financing on that.
So this is a serious question. You guys are going to think I'm crazy, but Black Luster Soldier says, these ads, do ads come up while you're watching this live? I have no idea. I truly don't know the answer to that. So do you
I pay for YouTube Premium because I hate the ads. I hate them.
I pay premium as well, so I don't see ads ever. But do ads pop up while we're talking here? I truly want to know the answer to that. So let me know.
In the rude. And then what does it do? Does it put them on delay so they don't miss anything? Or does the commercial just cut us off?
I swear I had no idea. I promise I did not know that. I thought it only did it on replays. I didn't know that it did it live.
Premium is a game changer. Once you have it, you'll be like, I would give up Spotify before I gave up YouTube Premium.
Absolutely. It's like $18 or something. No, maybe it's $22 for like 5
devices. They keep raising it. It's a bunch of crap.
Yeah. Anyway, we've been on an hour and 3 minutes tonight, guys. Hopefully you found some value. If you need touch with Josh, you want to get a second opinion, use that referral link on the bottom. You need a referral to an agent. I'm here to help. That link also gets to me. But we appreciate you being here. We appreciate the constant support. If there's something you want us to talk about on The Educated Homebuyer, let us know. But until next time, guys, adios.